Hi, everybody. Jeff Rivett, Portfolio Manager at Creed Capital Management. Hope that everyone's been enjoying this absolutely amazing summer weather that we're getting a bit early this year. Getting outside and spending time at the beach and hopefully just taking all the advantage of the vitamin D that you can. This is my June review. Just wanted to check in and talk about what's been happening. May was a bit challenging. Sort of January up until the beginning of May the markets were quite strong. We were seeing pretty consistent performance. May was a bit of a pullback. Probably the biggest issue that we were dealing with was continue to deal with is negotiations of the U.S. debt ceiling. I got a lot of questions about that this past month, and so I just thought I'd touch on that briefly. I've been doing this for almost 17 years now. We've approached the U.S. debt ceiling, probably at least 4 times that I can remember. And it does cause some chaos in the market. It certainly can be worrisome when you talk about the amounts of money that are being discussed. And the fact is that there's a lot of debt that exists in the world, and that's a problem that we will have to deal with one day. But generally speaking, I see U.S. debt ceiling negotiations as more noise than news. I think it's an opportunity for for a very politically charged conversation, and I do feel it's more of a political issue than a financial issue. I don't think it's a real threat to the market, so I'm not super worried about that. And we have seen, despite sort of a general pullback in May in most areas, one area that's very, very strong has been big tech in the U.S. And that's specifically companies like Apple, Amazon, Google, Microsoft, Tesla, Meta, which is Facebook, and NVIDIA. Those 7 companies alone make up about a quarter of the U.S. Stock market. In fact, I was reading this morning that Apple alone is 20% bigger than the entire Toronto, the TSX in Canada. So those companies have been doing very well, and have really been carrying the entire market. So when you look at the month of May, we saw commodities down, we saw emerging markets down. So Canada in general had a pretty poor May. International markets, same thing. And the fixed income markets, so the bond market did pull back about 1.5% as well, as interest rates started to rise a bit. So in general, again, really a market that's being driven by tech, and that tech drive now, I think is from 2 things. One, those same 7 companies were some of the worst companies last year, and so there's a bit of a comeback, which is what goes down tends to come back up in the stock market, and that does appear to be the case here, where we're essentially seeing a return to where these companies were at, and sometimes exceeding that at the beginning of 2022. The other big driver has been artificial intelligence, which I'm also getting a ton of questions about right now. I'd mentioned in a previous post that we do have some exposure to that area. It's something that we started to get kind of interested in back in December, really, which is the first time I was able to go out and use ChatGPT. I was fortunate to spend some time with family, and I had a cousin who was a software developer who was showing to me over Christmas, and it blew my mind. So Microsoft is, as I've said before, is 48% of ChatGPT. Made a very large investment, and that's a holding we've continued to add to and continue to really like, and certainly benefited from that. Another major holding in the portfolio would be Google, who's another big player in that space. So, in and of itself, do I think that there's a place for artificial intelligence and a place for it to be a driver of economic growth? Absolutely. But we see these trendy things come around quite often. Most recently would have been the cryptocurrencies. Prior to that, it was all the cannabis stocks. I remember, 3D printing was a big thing at one point too. And again, all these technologies have a place, and I certainly think that artificial intelligence has a place as well. But it may have run a little bit ahead of itself right now when we're seeing companies like Nvidia, which are up many times over based on demand for it. So, in general, it's great to have something going well. Because it seems like the last 18 months have been kind of a downer with inflation and high interest rates. So it's nice that we have something to look at to see sort of where the world can go and where we can develop. But in general, we're still fairly cautious. In our balanced model, we're permitted to have anywhere between 50 to 65% in stocks, in equities, and we're at about 57% right now. We still have a fairly large position in gold, just for that inflation protection and that safety. We also really like fixed income right now, and I've talked about that before as well. When you look at the yields, the actual interest rates that you're getting on holding very safe bond investments, and you compare that to the potential for what you can get in the stock market, that gap is quite small historically right now, meaning that you aren't necessarily getting fully compensated for taking the risks in equities. Although if you bought those 7 big tech giants, you'd be feeling pretty good. So in general, we are seeing that opportunity sort of in that bond space. We continue to like fixed income as a safe place. I think GIC rates are very attractive, and certainly I've talked to a lot of you about putting money in that space if it's money that you want to keep very safe, that you're not going to make a ton of money off of it, but you're going to make a good guaranteed rate of return. And then probably the other area we've been adding to in the fixed income space, and I'm still holding on to, is the preferred share space. That tends to be a market that moves up and down. Right now we're in a down spot, I think, but we're seeing dividend yields of 6-7%, which is very attractive. So we continue to add to that space as well. But overall, we're pretty neutral, playing it safe. We're thankful that we own Apple, Microsoft, Google, and Amazon, and that's been very nice in the portfolio. We continue to see outperformance in our portfolio this year compared to most, which is the goal. So we're happy with the results we're seeing, but continuing to look for opportunities to either add to risk if we see opportunities for that, but also position very defensively, like I said, right now with lots of money in fixed income and safer investments. So as always, please reach out to me if you have any questions on anything happening in your portfolio. We're always here for you, and look forward to seeing you in the actual summer in July. Take care. Bye-bye.